Good evening, everyone. My name is Shantanu Sood, and currently I'm working as a fundamental analyst at Zumit Capital Private Limited. So, today I'll be presenting to you part two of the course Blockchain a Step Towards a Decentralized Economy. So, the part one of this course was covered by my colleague Arhan Parekh, and some of the topics that were discussed by him were the basics of blockchain technology, the Bitcoin white paper, the difference between public and private blockchain, and finally, the concept of decentralization. So if you haven't watched part one of this course, I'll strongly encourage you to do so because both the parts are interconnected. Now, the topics that I'll be covering in part two of this course is first, I'll start with a brief introduction of a company. Then we'll be looking at some of the examples of decentralization. Then we'll be looking at in what ways cryptos are similar to money. And after that, we'll be looking at major factors that affect cryptocurrency price movements. And after that, we'll be looking at why are governments around the world hesitant about cryptos. And then finally, we'll look at regulations around crypto in India. Zumit Capital Private Limited was founded in 2017, and it is a boutique portfolio advisory firm that specializes in building and managing equity portfolios in Indian and global equity markets. Along with this, we also provide advisory services in cryptocurrency space, and along with this, we also provide technical trading calls to our clients. We are also present in the investor immigration space and provide immigration solutions to high net worth individual clients who want to settle abroad. Decentralization as a concept was covered in a very comprehensive way in the first part of this course. And in this part, I won't be talking about what decentralization is, and instead, I'll only be providing examples of decentralization. So the first example of decentralization that we'll look at is a DAO. So DAO stands for Decentralized Autonomous Organization, and it is an organization that is run by its members on the basis of some set of rules that are decided by a consensus process. Then these rules are converted into smart contracts and run on a blockchain network. So now the next question arises that what exactly are smart contracts? So smart contracts are nothing but computer programs that are run on a blockchain network. Now let's understand DAO by taking an example of a public limited company. So in a public limited company, we have all this, we have an entire hierarchical structure. Like there are promoters of the company, then there are shareholders, then there is a CEO, and then there is a board of directors. If we look at the structure of a traditional public limited company, then we'll find out that there are a bunch of people who are very powerful in the organization, and they have the authority to control the entire organization. But in a DAO, all this is done away with, and there is no hierarchical structure, and decisions are taken through a consensus process in a DAO. There are no one who is more powerful than any other person. People are equally have equal authority to run the organization. Let's take an example. Let's say that I want to put in a proposal to increase my salary in a traditional public limited company. So in a traditional public limited company, this proposal will go through a bunch of people like the HR of the company or someone else who has the ability to take decisions regarding whether my salary should be increased or not. And this decision to a certain extent will be on the basis of their discretion. But in a DAO, if I put in the same proposal, then if certain predefined conditions related to salary agreement are met, then my salary will be automatically increased, and no one individual or a group of people will be able to stop it from happening. Now, the next example that we'll look at of decentralization is DeFi. So DeFi basically stands for decentralized finance. So let's again understand this by comparing it to a traditional financial system. Let's take an example. Let's say I want to buy 100 shares of XYZ Limited in the current financial system that we have, which is the traditional financial system. So in this financial system, there are a lot of intermediaries. And to complete this transaction will have to go through all these intermediaries like regulatory authorities, then there are stock exchanges, then there are stock brokers, and then there are depository participants. So this will result in frictions in terms of transaction costs and time taken to complete the transaction. But in a decentralized financial world, all this is done away with, and I can directly do this transaction with the seller of these securities. Which will result in lower transaction costs and less time taken to complete the transaction. This is what DeFi is in a very brief way. So now we'll be comparing cryptocurrencies to money. So an interesting thing related to Bitcoin, which was the first cryptocurrency, is that in its white paper, which was written by Satoshi Nakamoto in 2008, was that he never called Bitcoin as equivalent of money or as something that can replace money. Surely he's said that Bitcoin is a system of payments, but he never said that it can replace money. So, a traditional fiat currency of a country has certain characteristics to it. Like it is issued by some authority and like a government of a country or a king, and it is highly regulated and it can be used to buy and sell things, and it is widely accepted. So if we see cryptos from the perspective of issuing, then we'll find out that they are not issued by any entity and they are completely based on a decentralized network. So there is no authority that regulates it or owns it. So if we see it from this perspective, then cryptocurrencies cannot be considered as money. Now, next is from the perspective of buying things. So people who support cryptocurrencies say that as cryptocurrencies can be used to buy things, therefore they can be considered as money. So as a matter of fact, gold can also be used to buy things in certain cases. So will that mean that gold can be considered as money? So no, right? Because surely it can be considered as a store of value, but gold can never be considered as money. So same is the case with cryptocurrencies. Additionally, around 99% transactions currently are taking place in fiat currencies, and therefore, cryptocurrencies still remain a fringe activity. And therefore, it will be premature on our part to consider cryptocurrencies as money as of now. So, next we'll look at some of the factors that affect cryptocurrency price movement. So, first is the supply and demand factors. So, like any other asset class or any other commodity, cryptocurrencies are also massively affected by the supply and demand factors. So, let's say new investors come into the market who weren't already present in the market, and they bring new funds to the market. This will result in increase in demand in the market, and this will in turn result in increased prices of cryptocurrencies. Besides this, the supply of cryptocurrencies, at least in cases of some top cryptocurrencies like Bitcoin, is fixed. And therefore, when this new money comes into the market, this will result in a upward price pressure. The second is institutional investors. So traditionally, institutional investors have always been a massive force in any asset class. So their actions have a massive weightage on what happens in the market because they have massive funds at their disposal. So now I'm here not talking about high frequency traders or trading institutional investors, but I'm talking about institutional investors that are buying and holding cryptocurrencies for long term. And when these institutional investors buy cryptocurrencies, this results in increased demand in the market. And as the supply is limited, therefore the prices of the cryptocurrencies shoot up. So again, if when institutional investors start taking out their money from cryptocurrencies, as they have massive funds in the market, and when they take out these funds from the market, then the supply of the cryptocurrencies remain fixed, but demand reduces, and therefore it results in a downward pressure in the prices of cryptocurrencies. Now, next are the algorithmic reasons. So there are certain algorithmic reasons that are related to cryptocurrencies which affect their price movements. So for this, let's take example of Bitcoin. So there will be only 21 million Bitcoin in existence, and because they are programmed in this way. So the mining of Bitcoin will take place till 2136, and there will be only 21 million Bitcoins. And every 4 years, the number of Bitcoins that are mined are halved. So this results in a reduced supply in the market, and as the demand is increasing or constant, therefore it results in upward price pressure in the market. Now, next is the legal and regulatory issues. So every asset or everything has to abide by the rule of the land, and what regulatory authorities think about cryptocurrencies will always have a massive impact on their prices. So uh, last year, there was a news that Russia might ban cryptocurrencies. So when this news came out, the cryptocurrencies fell massively, and this is one of the primary reason that why cryptocurrencies are so volatile. Next is the news. So we all have seen how news plays out in the cryptocurrency markets. Like we have seen like how Elon Musk was able to manipulate the cryptocurrency markets. So whether it was right or wrong is a matter of another debate. But uh, we have seen that people who are powerful or who have a massive fan following uh, can affect cryptocurrency price movements in a positive as well as in a negative way. So now is the next is the FOMO effect. So let's say you invested 10,000 rupees in Bitcoin, and you are sitting at a good profit of around 5,000 rupees. Now seeing this, your friend sees this and he thinks that maybe I should also start investing in cryptocurrencies as I'll miss this opportunity. And he also buys cryptocurrency at the price of 15,000 rupees. So this exactly is what FOMO effect is. So FOMO basically means fear of missing out, and we have seen that in cryptocurrency markets, it is much prominent of a phenomenon than in comparison to other asset classes. So now we'll be looking at why governments around the world are hesitant about cryptos. So first is that it undermines sovereign currency of a country. So a traditional sovereign currency has all these regulations around it to track the supply and uh, flow of money in the economy. And out of a sudden, here comes a technology that shows the potential to replace the traditional fiat currency of a country. So this undermines the sovereign currency of a country, and therefore it is a cause of massive concern for the governments. So governments are fine up to the point where cryptocurrency remains a fringe activity. But if it tries to take place of a traditional sovereign currency of the country, then the concern of the governments are valid. Now, next is it undermines the control of government over the economy. So, in a traditional financial system, the governments control the economy by controlling the supply of money in the economy. So, they do so by increasing and decreasing interest rates. So, let's say they want to expand the economy, then they'll reduce the interest rates. And if they want to contract the economy, then they'll increase the interest rates. So, as cryptocurrencies are not controlled by any authority, then a genuine cause of concern occurs is that how will the government be able to control the economy if cryptocurrencies become a mainstream activity? Now, next is tax avoidance. So, as cryptocurrencies cannot be tracked, you can only know the amount of transaction that has taken place, but you will not know between which parties this transaction has taken place. This results in a massive problem of tax avoidance. Like same is the case with cash transactions. Like it is very difficult to track it. In cash transactions, it is still possible to a certain extent, but in cryptocurrency, it will be very difficult for the regulators to track supply of money, a flow of money. Sorry. So besides this, India already has a massive problem of a shadow economy, which is fueled by the black money. And if cryptocurrencies become a mainstream activity, then a cause of concern for government will be how they will be able to hold people liable for taxes. Now, next is that cryptocurrencies can be used for illegal activities. Now, another major concern of the governments is that cryptocurrencies may be used for the illegal activities. But ironical thing about this is that any other assets can be used for illegal activities. Like if there was a study done in USA, which is called cocaine on dollar bills. So it shows that it shows that every third of four notes are have cocaine traces on it. So if we see it from this perspective, then anything can be used for illegal activities. So these were all the factors that because of which governments are hesitant about cryptos. Now we'll be discussing regulations around cryptocurrency in India. So first is 30% tax on cryptocurrency. So on 1st February, the Honorable Finance Minister of India, Mrs. Nirmala Sitharaman, uh, brought forward some of the regulations around crypto in India. And first was that 30% crypto tax will be deducted. So this 30% crypto tax will be a flat tax, and it will irrespective of your income tax slab. And let's say you had invested 10,000 rupees in Bitcoin, and now you sold your 10,000, you sold your Bitcoin for 15,000 rupees. Then on a profit of 5,000 rupees, you will have to pay a tax of 30%, which comes out to be 1,500 rupees. And it will not be dependent on your income tax slab. Like if you earn less than 5 lakh rupees, then also you'll have to pay this 30% tax. And uh, if you earn money, if you earn more than 15 lakh rupees, then also you'll have to pay this tax. So another thing related to this is that you will not be able to set off your losses in cryptocurrency against the profits of cryptocurrency next year. So let's say you made a profit of 5,000 rupees in current year, and in this year, and in next year, let's say you made a loss of 5,000 rupees in current year, in this year, and in next year you made a profit of 4,000 rupees in next year. So what the government says is that you cannot set off your losses of previous year uh, against the profits of next year. Second is that there will be no deduction in any expenditure or allowance. So this basically means is that any expenditure or allowance other than the cost of acquisition, you will not get any deduction related to that. Like there are in other asset classes, there are deduction of under ATC of like house rent allowance and things like that. But in case of crypto, if you say that I have used the profit to pay my house rent, then you will not be able to get any deduction. So let's further continue the example taken in previous point. So let's say you had a profit of 5,000 rupees on an investment of 10,000 rupees. So you will have to pay 30% flat tax on that 5,000 rupees. You cannot say that I have paid house rent of 2,000 rupees from that profit of 5,000 rupees. Next is 1% TDS. So this rule is that if you have a transaction of more than 50,000 rupees in digital assets, then you will be liable to pay 1% TDS on that transaction. So this TDS is not any additional tax, but it is an advanced tax. So when you file for your income tax returns, then this 1% TDS will be adjusted in the 30% tax on cryptocurrency. So now next is government to launch its own cryptocurrency, CBDC. So CBDC stands for Central Bank Digital Currency, and this is this currency will be launched by Reserve Bank of India, and it will have certain features of cryptocurrencies, but it will not be completely like a cryptocurrency. So the difference between a traditional cryptocurrency and this will be that it will be a legal tender and it would be backed by the government. And also uh, like traditional cryptocurrencies are like commodities right now, but this will have but the 1 unit of a CBDC will be equal to 1 unit of a fiat currency. So this was all from my side, and thank you for watching this course. And if you have any questions, then you can contact us on the following email IDs, or you can post your question in the comment section. So thank you.